You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Hey, hello. Welcome back to another episode of The Builder's Mindset. We'll see who was watching versus listening based on what just happened there. Anyway, so here we are. It is July 2nd. Half a year, half of 2025 in the books, in the bank, and we thought we'd do a Builder's Mindset mid-year 2025 construction check-in. We're going to cover new home construction. That'll probably we go into the most depth as typical. We're going to touch on custom and small builder market. We'll dabble a little bit over into the rental market. Then we're going to talk about remodeling, and we'll give a little high level on commercial construction and industrial and infrastructure, which we won't go too deep in that because that is not my foray, but I will tell you that is an exciting sector right now, in my opinion. As you know, here at the Builder's Mindset, we like you to focus on the facts, not the headlines. And we always like you to try to dig and find the positive trends that we're looking for. So, new home construction, unless you've been, kind of living in a cave or under a rock, things are slowing up a bit, but it's not crashing. It's not the end of the world. It's not what we'd like it to be. But I think it's going to create some major shifts in policy, process, and product as we go through the next few years. So it's cooled off a bit. Starts are down, especially multifamily seems to be a little bit down, but single family as well. Builder confidence metrics are at, big time lows. Single family starts. It depends on the region. I'll go into a little bit of that region by region, where things, the Midwest is a bright spot right now. And the high mortgage rates, 6.8%, home prices, keeping buyers on the fence, and builders continue to respond with price cuts, incentives, and sales are down and inventory. It was building, but I think the builders are getting a handle on it now and starting to control the inventory. They're really trying to do some work through that. We've got about, depending upon the market you're in, we have nearly a 10-month supply of new homes on the market maybe. But I would say, once again, it is not all gloom and doom. So we're going to jump in. Let's talk about the U.S. Census monthly new residential construction report for right now. I think we're still looking at May. I don't think they put out, they won't get the June numbers out for a little bit. So we might have to update and evaluate that. But right now what they're saying through May, is May was at a seasonally, for permits, May was at a seasonally adjusted annual rate of 1.393 million. Now, while that is 2% below the April revision number of 1.422 and 1.1% below May 2024 of 1.407, I don't look at that as horrific, not horrible. That's just indicative of the inventory is getting up, sales are slowing, and so builders are kind of taking the foot off the gas a little bit. Housing starts in May. We're at a seasonally adjusted annual rate of 1.256, 9.8% below April's revised 1.392, and 4.6% below May of 2024. And as we talked about, this is going to be the flat to down year. I'm still holding at that plus or minus 5% on closings for the year, but we'll get into that later. But the bright spot, I think, here is that single family housing starts in May. We're at a rate of 924,000. This is 0.4% above the revised April figure of 920,000. So there is some bright spots in things in the data here. The housing starts, I don't expect them to be on fire, but I expect the builders to try to get them in line with sales and also try to get things to where they're utilizing their existing inventory as best that they can. So So just to clarify back to that, the single family starts were basically flat, 0.4% up. Single family detached homes, the overall housing starts were down. And so, that's why there's signs of the multifamily is sort of struggling, but we'll get into that in the regional data, a little bit more details. Housing completions. Completions in May were at a seasonally adjusted annual rate of 1.526, 5.4% above the revised estimate of 1.448, but it's 2.2% below May of last year. Single family housing completions in May were at a rate of 1.027 million homes, 8.1% above the revised April. So, completions are still holding steady. Starts, as we expected, and permits, we're going to ease up a little bit because builders are trying to get their inventory back in check. So when we go to look at the permit issue data and we look at it regionally and seasonally adjusted, the 5 units or more nationally permits were up. 1 and 2 to 4 units were down. In the Northeast, they were up, both their single units and their multifamily units. The Midwest was up in a big way. Their permits were up 16.4%, and single family, were up 9.6%. The South and the West, and we've talked about what's going on in Texas and Florida, and the West has some hot markets. The West would include Arizona. The South, total permits were down just under 5%. Single family were down just under 9%. So in that market, the multifamily is still kind of helping out a little bit. In the West, total permits were down 3.1%, and single family permits were down 10.1%. I think you got markets like Arizona, and I don't know where they put Denver. Denver's Colorado. I don't know if they put it in the Midwest, or I'll have to look into that and get back to you. But the South and the West are struggling. The Northeast and the Midwest are doing okay. When we look at year-to-date percentage change, which I think is also a good number to take a look at, is that the overall the United States year-to-date, we're down 4.7% on permits. Single family, we're down 5.9%, but 2 to 4 units are up 5.4%. So multifamily is trending up a little bit more optimistic. And the 5 units are more down. So it's really what you would see is what I see in that. If your permits are increasing in 2 to 4 unit buildings, that's sort of more your townhome communities. That's not your larger complex type stuff. And so that's builders just adjusting, trying to get better density, get their overall cost down. So there's nothing wrong with that. In the Northeast, permits were down 17.2%. And single units were up 2.5%. So go figure that. So that sounds like their multifamily units are suffering a little bit there because they're dragging that down. The Midwest, which is the bright spot, total permits were up 6%. Single units were up 0.4%. So not a big jump on their single family units, but 6% overall is the Midwest year to date, year over year. Phenomenal number. The Midwest is coming back strong. We'll talk about that in the industrial sector a little bit. And then in the South, we're down 5.4%, and in the West down 3.7%. So, we got some headwinds, right? We're challenging some headwinds. So really quick, let's start with, now we'll cover the percent change from May to May, year over year, started homes. We are down nationally 4.6%, but five or more, the larger attached buildings are up 5%. Okay. Northeast, we are up 6.1%. The caveat on that is we're down 8.6% on single family detached. So the Northeast is pulling a lot of multifamily stuff is what they're working on. The Midwest, we are up on total 26% and up 32% on single family detached. The Midwest is going to be the shining bright star in this downturn, I think. Just because you just look at the data. Builders could pull, these are started homes. So like that means those builders in that market are optimistic. South and the West, another story. South permits, starts in the South are down. Total permits down 7.2%, and the West total permits are down 15.2%. So we got some challenges, headway there. The Northeast really is doing okay, and the Midwest solid. The South and the West they're struggling a bit. So let's talk about units completed. From May 2025, from May 2024, units completed, we've got up 48% in the Northeast total, and the singles are down 17.6. So they're knocking out and completing a lot of multifamily stuff. In the Midwest total, their completed units down 9.6%, but up 5.4% on their single units. So the single family homes in Midwest, which is kind of a product that makes sense out there. They're not really, you got Ohio and what else would be in that? Ohio, Kentucky, that up Indiana. That's not really a multifamily market. All right, so the South. So the South, we're down 13.8% in total, only 8% on single family, and that could be a total unit. Let's see. So the South, the single family is not down quite as much, but they're definitely slowing up. 13.3% and 8% down. The West, and that was in, once again, we're talking about completed homes. The West, as we've been talking about, the West has been a bright, shining star rolling into this sort of softening we've talked about. It's been holding steady, but you got to look at where it's trending and whatnot. So, because the West does include your Arizona, your Utah, your Nevada. Nevada's really slow right now. I think Arizona's kind of stabilizing at this point, but they had a big inventory run up. But Southern California has really been driving the driving force for a lot of this. But in the West, completions, units completed total, were up 13.7% from May of 2024 to May of 2025. And the one unit, so the single family units, were up 25%. So the West was really, really holding strong in terms of pulling in their completions. But as we said, if you go back and you look at the starts in the West, they're down 15.4% and 17.1%. So they're seeing the slowdown as well. And so they're starting to slow. They're starting fewer homes, but closing as many as they can. So it's kind of a mixed bag. We'll really just have to see and track the selling season. What's really going to be interesting from a confidence perspective is when we see the July starts, because as I've said, July starts are typically January closings, and all the builders are still prepping up and forecasting for a big 2026. So if they're going to have a big 2026, they've got to start that 2026 in 2025, July 2025 to be specific. When we look at the indexes and builder sentiment, the NAHB Wells Fargo Housing Market Index, a couple of highlights from that. The current sales conditions on this metric fell 2 points to 35. Sales expectations in the next 6 months dropped 2 points lower to 40. And traffic of prospective buyers posted a 2-point decline to 21. Important to note, 37% of builders reported cutting prices in June, the highest percentage since it's been tracked monthly in 2022. This compares with 34% who reported cutting prices in May, and 29 in April. So builders are making adjustments. They're doing what they need to do to get inventory back in check. I think that's smart. Inventory is a little higher than we'd like. Some markets are not as bad as others, but they're doing what they need to do to move the inventory. The average price reduction was 5%. That can mean a lot. I think like the average price of of a home. New home is I think I said nationally it's $462,000. So that's basically saying they've lowered the price by about 23-ish thousand dollars, and it's been the same number since last November. And the use of sales incentives was 62% in June, up 1% from May. So, builders are incentivizing, they're starting to lower prices. The sentiment is a little bit down. It's definitely not going up. And, we've seen it a lot worse. This is not horrible. Remember, if we're selling 2.5, 3 houses a month per community, we'll make it through this. Let's now talk about U.S. existing home sales. Because they rose in May. I want to talk a little bit about that data because there's historically been a lot of talk about the high interest rates making it hard for for consumers to purchase existing homes because those sellers don't have the money to do the rate buy downs. And so that's what's helped the new home construction market. But home sales climbed 0.8% last month to a seasonally adjusted annual rate of 4.03 million units. Economists polled by Reuters had forecasted home resales falling to a rate of 3.95, but instead it's actually rising 0.8%. Not a whole lot, but definitely in the market that we're in, that is a bright spot. They're calling it an unexpected increase in May. The sales pace was the slowest for the month since May of 2009. Sales fell 0.7% on a year-over-year basis, and of course, then the articles like to focus on that. But there's a lot to be concerned about. So sales are relatively subdued due to persistently high mortgage rates, said Lawrence Young, the NAR's chief economist. If mortgage rates decrease in the second half of this year, expect home sales across the country to increase. We've talked about this before, and this was just mentioned in an article I read. These interest rates that everybody's hoping for the Fed to drop down, from a new home perspective, will not have a marginal impact in any way, shape, or form. They'll have a bigger impact in terms of resale market, which could create more competition for the new home market. Why do I say that? Because right now, most builders are buying mortgages down to 4 to 5%. So if mortgage rates drop from 6.8 to 5.8, it's not going to really help the consumer. I've been talking about this for a while. But if you're trying to sell your home as an individual, and now that consumer can get 6% loan instead of 7%, they now have a level playing field as it relates to all the people bidding on those existing homes because the rates will come down. Because as we said, home sellers, private home sellers, they don't have 20, 30, 40 grand that they want to give away for mortgage rate buy downs. But this is good optimistic news that we're seeing here, that the average rate on the popular 30-year fixed rate mortgage was hovering at just under 7%, so it's holding steady. If mortgage rates come down, that will stimulate the existing sales market, which in turn could put some pressure on the new home market. So, all right. At the May sales pace, it would take 4.6 months to exhaust the current inventory. So that's up from 3.8 a year ago, but still not horrible. If you look at that, that's not a bad number to be at. And properties typically stayed on the market for 27 days last month compared to 24 days a year ago. You're still under 30. That's the other thing. That's where that proves to me there's demand. The inherent demand is there. They're not sitting on the market long. I think from what I see when I watch I follow a bunch of houses routinely on Redfin just to kind of see how the market's trending. And what I see is homes are still moving. They're moving within plus 0 minus 10% of their listed sales price, and buyers are getting flexible. Sellers are getting flexible with buyers in terms of pricing. So we're going to see that continue. Whether that puts more pressure on the new home construction market, that remains to be seen. All cash sales constituted 27% of transactions, down from 28% a year ago. Distressed sales, including foreclosures, made up 3% of transactions, up from 2% a year ago. So up, yes, nonetheless, but not brutal, not horrible. I think this is all, just leading to, we've got a mixed bag of what's going on. And, we have to weather the storm. And this comes back to, from a builder perspective, they're going to have to keep juicing the interest rates, and you're going to have to really start to operate as efficiently as you can, check your cost structure, design your new product right. I was just read an article about Hierarch, and they've picked up a few builders, former builder employees, to help with their solutions program. They build their setup as best in class speed of estimating from design to estimating. And I think we just got to see, though, if builders really start to do the things that need to be done, which is reduce the house size, get rid of the gingerbread, get rid of all the fancy stuff that is a want, not a need, because you can have the best software in the world, and that software could get you takeoffs in the matter of a snap of a finger. But if what we start out and the renderings we show the cities and the products that we have to put together, either because a city saw something already or because a division president likes walk-in closets, even though you don't really need them at a single family home, those are the things that add up, in my opinion, to really be the big problem, in terms of, we establish a budget based on backing into that land value, and we're like, oh, this is what we have to build these homes. We put it in the pro forma, we go under contract for the land, then we go hard on our money, and then we start to actually really design the product for that community. And at that point, the budget is baked because we bought the land. But even worse, to make matters worse, now what we do is we start working with cities and municipalities and giving them free reign to put a bunch of gingerbread on our houses and make the cost even worse. So we've got to be thoughtful of the wants and needs, not just of the buyers, but the wants and needs of your internal programs. I've worked for builders before that love to go above and beyond code on certain things that I don't feel the homeowner gets much value of or even knows about. So they've got some work to do in terms of really revamping the internal, inside the home builder, cultural paradigm and mindset of how do we design an affordable home. So one other regional point that I would like to point out is when we're looking at the HMI scores, the Midwest moved up 1 point to 41. Doesn't sound like a whole lot, but all the other regions were down. The Midwest went up 1 point to 41. This is why I'm saying the Midwest seems to be a bright spot in the marketplace. All right, so that's the new home kind of mid-year look. I'm still holding firm. We're going to end up at plus or minus 5% year over year for total closings of homes. Let's talk about the custom and small builder market. It seems to be holding steady. There's some bright spots there. They're treading water. They're not growing much, but they're not falling either. Custom homes make up around 18% of the single family market. These builders are less affected by mortgage rates since their clients are mostly paying cash or building long term. And so, their starts are flat year over year, which I would say is a win for them. And at 18% of the market, they could definitely end up being a real big bright spot for the year. So let's see how they pan out. Over the past 4 quarters, total custom home starts reached 181,000 nationwide. This marks progress from Q4 of 2024 when the total stood at 177,000. So, they're 18% of the single family starts. They could help the labor, have a bright spot to make its way through whatever we're calling this. I'm not going to say the D word or the R word. So, all right, rental market, renter friendly shift. The rental market is shifting in favor of tenants After years of rapid growth, national rent prices are starting to soften. Vacancy rates are up a bit. They're around 7% now. There's huge new numbers of apartments being delivered over the past year, and landlords are offering concessions, and rents are slightly down year over year in most major metro areas. So we'll dig in a little bit to that data real quick because we pulled up the apartment list national report. Rent increased 0.2% in June. The average now stands at $1,401. This is the 5th consecutive month that rents have trended up, but rent growth it has been slowing. So there's signs that it's kind of reaching that peak, but they are down 7% year over year. So some things to take a look at is we wanted to share with you multifamily. The vacancy rate hit 7%. That's a new peak. And list to lease time comes down from an all-time high. So the list to lease time peaked at 37 days nationally in January on an all-time high going back to the start of the data series tracking in 2019. The median time on market in May was 27 days. So we're looking at slightly reduced rates of or lease monthly payments, but reduced time from list to lease. And so the apartment market is holding reasonably steady. Whether or not a lot of these jobs that have been on hold, which I've heard a lot of those in the Southeast, it remains to be seen if those really start to pop. But right now, what I'm being told is that the differential cost between renting and buying a house is a lot more expensive today because of interest rates. So that's helping the rental market. Whether or not that bodes well for the construction industry, it remains to be seen. At the end of the day, we'd like to see home costs and home prices come down a little bit to make things a little bit more affordable. All right. So next up, we're going to talk a little bit about remodeling, because there was a lot of talk about remodeling during the pandemic. And so we're curious, like, kind of what's going on right now as it relates to remodeling, because you would think if people are stuck in their houses, right, that they would want to remodel. So you've got all these aging homes and lots of home equity and favorable demographics should create positive impact for 2025. Well, let's see what we're seeing. And the NAHB is forecasting residential remodeling activity to post a 5% gain in 2025 and a nominal 3% gain in 2026. Either way, those are both gains. They're both in the positive, and so it'll be curious to see if that comes to pass. In the remodeling index, which is it posted, let's see, what does it say? The National Association of Home Builders released its NAHB Westlake Royal Remodeling Market Index, the RMI, for the first quarter of 2025, posting a rating of 63, which was down 5 points compared to the previous quarter. Suppliers have already increased prices by an average of 6.9% since January due to the anticipation of tariffs. And, this is all of this is reflecting consumers not sure if this is the right time to make a big purchase or a big remodel. My argument would be is that if you're going to be in the house for 5+ years and you have the equity above and beyond what you plan to spend in the home, hopefully I would like to see you have 2x equity what you're going to put in the home. What I mean is, so let's say you have a house that's worth $1.5 million. If you owe $500,000 and you go put a $500,000 remodel in that, I think you're in good shape, right? So the index is showing that people are a little cautious, but still, optimistic. So the overall, as we said, the overall remodeling index was 63, down from 68 in Q4. The current market conditions index was 75, down from 71 in Q1. And the full future index, the future indicators index was 55, down from 61, so down 6 points. So as a recap, the remodeling index is down 5 points to 63, current conditions is down 4 points to 71, and the future indicators index is down 6 points to 55. Then they also looked at this and broke down that current conditions from what is for large jobs, 50,000 or more, that is down 9 points from 64 to 75. Current market for moderately sized, that's 20 to 50,000. That is down 1 point, 72 from 73. And the current market for small remodeling projects under 20 grand is flat at 76. So, the current backlog of remodeling projects is holding steady. It's at 58 when it was at 59, so not a big dip there. And then the current rate at which your leads and inquiries are coming in, that dropped 11 points from 62 to 51. So that does give me a little bit of pause and a little concern that I think some of the remodels are worried about getting their new business. So and that's just inflation costs. If you're getting a HELOC type mortgage or something to pull equity out of your home, rates are higher, so it's making it's reducing your spending value. So now let's take a quick look at the regional RMI index. So once again, what I say is it's flat to down except for the Midwest. The Midwest, their remodeling index and their current market conditions were up. Future margin index was solid, and so I see that Midwest as doing rather well, and it's probably one of the more affordable markets in the country. So not so great in the West, not so great in the Northeast, and not so great in the South. So people are getting a little nervous, but we're going to get through this. Okay, we're definitely going to get through this. One thing I thought I would point out is if you look at the overall RMI index, which we were at 63, right? We were down from 68. 63 in Q1 of 2025. The last time it was lower than that was Q1 of 2020. So first quarter is always awful. And so that gives me hope for the remodeling index because, we're not even close to the lows of, the time when we hit that sort of like the pandemic, time. I would say that's pandemic driven. So, and then if we look at the current conditions index, it's at 71, whereas in Q1 of 2020, it was 56. So still, again, even though things might be trending a little bit down on the remodeling index, the general feel is higher than it's been for quite some time. Now, here's a really good one. The future market index, it fell from 61 to 55 from Q4 to Q1 of 2025. But if we go back, if you look at Q1 of 2024, it was 59. And if we look at Q1 in 2020, it was 37. So right when COVID's taken off, and it's much higher than that. So I don't think it's as horrible as some of us might think. I think we're going to do just fine. And we just got to get through 2025. So what have I been telling everybody? Get on top of your costs and not just go buy some fancy estimating software. That'll help. That'll turn your speed around. But you got to start the estimating, you got to start the budget process. When you do a pro forma, you have got to get some pictures to the purchasing and estimating team early on, get a solid budget from them, and don't show anything to the cities until your purchasing team has said, we can buy what you're showing me for what you have in the budget, because otherwise you're just going to lose margin. All right, so let's wrap this up and bring it home. We'll talk about commercial construction. It's a mixed bag. The office sector is obviously struggling for a variety of reasons. Vacancy rates in major cities are over 20%, and new office construction is nearly non-existent. On the other hand, we'll talk about industrial construction like warehouses and logistics centers remain active, although the market may be reaching saturation. We'll see how that goes. Retail and hotel construction is selective and cautious, tied closely to local travel demands. All right. So the industrial and infrastructure, factory and AI boom we're talking about, you hear about it all the time unless you live under a rock. This is the construction sector's big win in 2025. Manufacturing tech infrastructure spending is still at record levels. Semiconductor fabs, EV plants, and now AI data centers are under construction across the country. The Stargate AI project, backed by OpenAI, SoftBank, and Oracle, will build 20 new data centers in the US with over $500 billion in investment. These large-scale projects are powering the construction industry forward, even as other sectors slow down. So there's a bright spot. There's a lot of industrial work going on, and with that, a lot of industrial work, particularly like those kinds of chip manufacturer plants, that creates good paying jobs here in the United States, both on the construction front end and then on the back end when they get up and operating, right? So that's pulling us through 2025 in a good way. A lot of talk about unemployment, where some people are expecting it to rise, but at the end of the day, unemployment is not horrible. The market is not horrible. These are interesting times, yes, to say the least, but they are not horrible. Keep your mind focused on what you can do to improve margin within your business and make your way through 2025 to get ready to take off the launch pad in 2026. Because all of this stuff that we're reading about that's not 100% hunky-dory we're working through it. It's not as bad as we think. We're still building some homes. We're selling some homes. Yes, starts are down a little bit. Yes, permits are down a little bit. That's a good thing. Let's get the inventory checked before it gets out of hand. And let's get these builders thinking on how to really reevaluate their cost structure. All right. Hey, thanks again for joining us. We appreciate you sticking around for this longer than normal episode. That was kind of a lot of input and data that we were sharing with you. But generally, what I would say is we're kind of floating through, cruising, coasting through 2025. We keep doing what we're doing. The back half, if you're a runner, you know what I mean when I say they always like negative splits in this industry. We always close more homes in the second half of this race than we do in the first. So I think we're in a good position to perform, and we've got enough homes started that we're going to deliver, and I'm still holding firm with my plus or minus 5% closings 2025 total over 2024. And then 2026, we'll see how that shapes up. I'll feel a little bit better after July starts numbers, and I see those, and really feel a little bit better after Q3 of 24 ends. But hope you enjoyed the episode. Thanks for joining us. You guys have a great day, and we'll talk to you next week.
You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.